Our next guest says, forget trade. There's something even bigger investors should be focused on. Let's bring in Mike Wilson, Morgan Stanley's chief U.S. equity strategist. Mike, always great to see you.
Thank you.
Bigger than trade? How can that be? What is it?
You guys are talking about it. There's a fundamental story here that's been going on all year, which is the business cycle is rolling over. And if I talk to a lot of clients, right, so I would say that people blame trade for 80% of the slowdown, and they think the business cycle is, on its own merit, 20% of the reason for the slowdown. I'm the other way. Our call has been that the business cycle is really 80% of the reason for why things have been slowing, and trade has been like a cherry on top, which is just kind of reduced confidence and taking some edge. For Germany, it's been worse, obviously, than other parts of the world, but it's not the main driver. Mm-hmm. And so for me, this is a sell the news event. And it's interesting to hear all of you talk somewhat cautiously. That should make us maybe more bullish, but I think that's right. In other words, we're in a bear market, right? We've been chopping around now for 18 months, and it's a rolling bear market. It's not devastating, but there have been some areas that have been hit pretty hard. And in a bear market, you're supposed to be bearish. So I think sentiment can stay negative for a while until we see a trough in the earnings revisions. We see kind of a trough in some of the global indicators that maybe things are bottoming out. And I just don't see that for another 3 or 6 months. Our work is very clear. It's been clear for 18 months, and I just don't see that trough until the first quarter.
So, Mike, this time last year, it seemed a lot of complacency, but there was also a lot of optimism despite rising rates at the time. And I don't think anyone foresaw a 20% peak to trough decline in the U.S. equities in such a short period of time. What do you think the probability of that is now? Now, obviously, the rate situation is very different, and I wonder, does that give you a bit of a cushion for what might be, a modest sell-off compared to what a 20% one last Q4?
Yeah, I think the chance of a 20% sell-off at the index level is very low. We've been adamant about that because the Fed is in a different place. They're not tightening anymore. That's good. That will cushion the blow. The fundamentals are going to start to deteriorate again. It's interesting. Last year, the market held up until September, and the reason why it held up until September is because the forward year numbers typically don't come down until the fourth quarter. So, Karen, you mentioned Delta. I think we're going to see a lot of that fourth quarter, and then, of course, that's going to happen for other companies. And once the forward numbers come down, then we can have a correction. But I don't think it's more than 10% at the index level. What we're focused on now is we think all the risk is in a few areas, and it's primarily in the growth stocks within the U.S., because that's the area that has been treated as a kind of protected species, along with the defensive stocks, in an economic slowdown. And I think that's incorrect, meaning the defensive stocks always trade well into a slowdown. They should, because they're bond proxies and they're defensive. But growth stocks generally are cyclical. A lot of them are cyclical, and I think we're going to see that now. And those stocks could go down 20%, 30%.
Don't the valuations of the defensive sectors worry you this time around, though? I mean, when you're talking about utilities,
yeah,
and you're taking a look at these levels and these valuations, I mean, isn't this just as dangerous as the growth stocks could be? It's
a great question. They're not at this stage of the cycle. So we're of the view that in July, when the market figured out the Fed was going to be cutting rates, that was a transition from late cycle to end of cycle. And so we made a call that we said, okay, now the momentum part of the trade has been defensives and growth together. That's now going to split. The defensives will outperform the growth stocks. And that's exactly what's been happening. So in other words, the market is confirming our view that it's end of cycle. So the defensives will stay expensive until the yield curve starts to re-steepen and the Fed gets in front of it and people really acknowledge that there's a recession coming and the earnings have to come down a lot more. Once that happens, then the defensives are going to be very vulnerable.
What would you need to see to make you think, all right, there are a few more innings left in this cycle of expansion?
Well, I tell you, I mean, it's getting harder. I just don't know what that would be. It had to be some sort of an exogenous fiscal stimulus, probably either from Germany or another part of the world. It's not coming from the United States. I don't think it's tomorrow. I don't think that they're going to roll back, okay, the tariffs that are already in place. If they were to do that, and they said, okay, we're actually going to roll back the tariffs in September. We're going to roll back the tariffs we did in July. Now, maybe that could gin up, animal spirits one more time. But I don't think that's happening tomorrow. But of course, I have no idea what's going to happen tomorrow morning.
So, Mike, the Fed seems to have dampened volatility in the equities market. But the U.S. bond market, which is the biggest bond market on the planet, volatility has been historic in terms of percentage moves. 3.15% down to 147, back to 182. I mean, it's pretty crazy in a short period of time. Is the volatility in the bond market sort of a scary thing potentially for U.S. equities?
Well, it's a dampener for how much risk you can hold, right? So, one of the things that gets cited all the time is that institutional investors' exposures have come down a lot, right? Retail investors are heavily in cash. But let's talk about the institutional investor. They can't hold as much risk in an environment where you've got that kind of volatility in the pricing mechanism for equities. So I think lower yields is unequivocally positive for valuations, but the higher volatility has to knock it down a bit. So I think stocks are okay. I mean, they're fairly valued given what's going on at the index level. The problem, once again, is you have these areas of expensiveness. And I would still choose defensives over growth stocks if I have to choose one.
Okay, 27 to 3,000 your range on the S&P.
Still 2,700, 3,000. Yeah.
Mike, good to see you. Thank you.
You too, thank
Mike
you.
Wilson, Morgan Stanley. I think the point Mike was making was really interesting and right on in terms of if you took away China trade, would that change anything about the economic backdrop for the S&P 500?
That is the big question, is that whether or not this kind of cyclical downturn is inevitable, right? We know that the business cycle hasn't been extinguished. It still exists. So are we just seeing the natural workings of an economy and the trade has just kind of exacerbated it? If that is the case, which Mike has, it's been proven to be right. Mike's said that for a long time. Then, yeah, I think we are headed lower and it doesn't even matter if the Fed cuts rates because you're talking about companies that it doesn't matter. They're not going to hire somebody else because rates are down 25 basis points. There's no CEO out there going, boy, money's so tight I can't hire that marginal worker.